Well, let's talk about what a cap rate actually is for a second. So a cap rate is basically when you take the net operating income of a property, and by the way, net operating income means gross income, in other words, the gross rent from a property, and you subtract the expenses. Now, typically, we subtract both the fixed and also potential variable expenses. So fixed expenses would be things like taxes, insurance, and utilities that the landlord's paying. Variable expenses would be things like maybe property management or vacancy factors, or possibly repairs and maintenance budgets. I usually use between 20 to 30% for variable expenses of the gross income. So if the gross income, let's say, is $20,000 a year, a good number to use for variable expenses would be about $4,000 a year that you take off the top right away. So that will leave us with $16,000, and then let's say the fixed expenses were another $6K. That's leaving you at basically $10K of total net operating income. So net operating income of $10K, okay, divide that by your total cash outlay to get into the deal. Total investment, I should say, not cash. Total investment to get in the deal. It doesn't matter if it's cash or anything else. Total investment to get in the deal, you're looking at, let's say it's $100,000, just as a round number. $100,000, you get 10%. You get 10K return on net operating income. That's a 10% cap rate, basically, or return on investment. So that's how you look at buy and hold deals typically. When you have multiple units, like 2 units and above, you want to look at them from a cap rate perspective. It's very difficult, at least in the state of New Jersey, to get good ROIs, good cap rates on properties that are single family, because the cost to acquire a property is way more than the rent that you're going to get out of it. So typically when you're looking at cap rates, you want to use that on multifamily or commercial deals. The question was, do we always use it? And the answer is we always use it when it's necessary to use it, like on multifamily deals. You want to know what the cash flow is looking like. So you definitely want to do that, and hope that answers your question.